In economics and finance, arbitrage is the practice of taking advantage of a price difference between two or more markets, striking a combination of matching deals that capitalize upon the imbalance, the profit being the difference between the market prices. When used by academics, an arbitrage is a transaction that involves no negative cash flow at any probabilistic or temporal state and a positive cash flow in at least one state. In simple terms, it is the possibility of a risk-free profit after transaction costs. For instance, an arbitrage is present when there is the opportunity to instantaneously buy low and sell high. In principle and in academic use, and arbitrage is risk-free. In common use, as in statistical arbitrage, it may refer to expected profit, though losses may occur, and in practice, there are always risks in arbitrage, some minor, some major. In academic use, and arbitrage involves taking advantage of differences in price of a single asset or identical cash flows. In common use, it is also used to refer to differences between similar assets, as in merger arbitrage. People who engage in arbitrage are called arbitrageurs, arbitr, such as a bank or brokerage firm. The term is mainly applied to trading in financial instruments, such as bonds, stocks, derivatives, commodities and currencies. Arbitrage-free. If the market prices do not allow for profitable arbitrage, the prices are said to constitute an arbitrage equilibrium, or arbitrage-free market. An arbitrage equilibrium is a precondition for a general economic equilibrium. The no arbitrage assumption is used in quantitative finance to calculate a unique risk-neutral price for derivatives. Arbitrage-free pricing approach for bonds. This refers to the method of valuing a coupon-bearing financial instrument by discounting its future cash flows by multiple discount rates. By doing so, a more accurate price will be obtained than if the price is calculated with a present value pricing approach. Arbitrage-free pricing is used for bond valuation and used to detect arbitrage opportunities for investors. For purpose of valuing the price of a bond, its cash flows can each be thought of as packets of incremental cash flows, with a large packet upon maturity being the principal. Since the cash flows are dispersed throughout future periods, they must be discounted back to the present. In the present value approach, the cash flows are discounted with one discount rate to find the price of the bond. In arbitrage-free pricing, multiple discount rates are used. The present value approach assumes that the yield of the bond will stay the same until maturity. This is a simplified model, because interest rates may fluctuate in the future, which in turn affects the yield on the bond. The discount rate may be different for each of the cash flows for this reason. Each cash flow can be considered a zero-coupon instrument that pays one payment upon maturity. The discount rates used should be the rates of multiple zero-coupon bonds with maturity dates same as each cash flow and similar risk as the instrument being valued. By using multiple discount rates, the arbitrage-free price will be the sum of the discounted cash flows. Arbitrage-free price refers to the price at which no price arbitrage is possible. The ideas of using multiple discount rates obtained from zero-coupon bonds and discount a similar bond's cash flow to find its price is derived from the yield curve. The yield curve is a curve of the yields of the same bond with different maturities. This curve can be used to view trends in the market's expectations of how interest rates will move in the future. In arbitrage-free pricing of a bond, a yield curve of similar zero-coupon bonds with different maturities is created. If the curve were to be created with treasury securities of different maturities, they would be stripped of their coupon payments through bootstrapping. This is to transform the bonds into zero-coupon bonds. The yield of these zero-coupon bonds would then be plotted on a diagram with time on the x-axis and yield on the y-axis. Since the yield curve in a way displays the market's expectations on how yields and interest rates may move, the arbitrage-free pricing approach is more realistic than using only one discount rate. With this, investors can use this approach to value bonds and find mismatches in prices, resulting in an arbitrage opportunity. If a bond valued with the arbitrage-free pricing approach turns out to be priced higher in the market, an investor could have such an opportunity. Investor goes short the bond at price at time t1. Investor goes long the zero-coupon bonds making up the related yield curve and strip and sell any coupon payments at t1. As t greater than t1, the price spread between the prices will decrease. At maturity, the prices will converge and be equal. Investor exits both the long and short position, realizing a profit. If the outcome from the valuation were the reverse case, the opposite positions would be taken in the bonds. This arbitrage opportunity comes from the assumption that the prices of bonds with the same properties will converge upon maturity. This can be explained through market efficiency, which states that arbitrage opportunities will eventually be discovered and corrected accordingly. The prices of the bonds in T1 move closer together to finally become the same at TT. Conditions for arbitrage. Arbitrage is possible when one of three conditions is met. The same asset does not trade at the same price on all markets. Two assets with identical cash flows do not trade at the same price. An asset with a known price in the future does not today trade at its future price discounted at the risk-free interest rate. Arbitrage is not simply the act of buying a product in one market and selling it in another for a higher price at some later time. The transactions must occur simultaneously to avoid exposure to market risk, or the risk that prices may change on one market before both transactions are complete. In practical terms, this is generally possible only with securities and financial products that can be traded electronically, and even then, when each leg of the trade is executed, the prices in the market may have moved. Missing one of the legs of the trade is called execution risk, or more specifically, leg risk. In the simplest example, any good sold in one market should sell for the same price in another. Traders may, for example, find that the price of wheat is lower in agricultural regions than in cities, purchase the good, and transport it to another region to sell at a higher price. This type of price arbitrage is the most common, but this simple example ignores the cost of transport, storage, risk, and other factors. True arbitrage requires that there be no market risk involved. Where securities are traded on more than one exchange, arbitrage occurs by simultaneously buying in one and selling on the other. See rational pricing, particularly arbitrage mechanics, for further discussion. Mathematically, it is defined as follows, where N denotes the portfolio value at time t. Examples. Suppose that an exchange rate in London is £5 equals 1,000 yen and the exchange rate in Tokyo is 1,000 yen equals £6. Converting 2,000 yen to £12 in Tokyo, and converting that £12 into 2,400 yen in London, for a profit of 400 yen, would be arbitrage. In reality, this arbitrage is so simple that it almost never occurs. But more complicated foreign exchange arbitrages, such as the spot forward arbitrage, are much more common. One example of arbitrage involves the New York Stock Exchange and the Security Futures Exchange 1 Chicago. When the price of a stock on the NYSE and its corresponding futures contract on OCX are out of sync, one can buy the less expensive one and sell it on the more expensive market. Because the differences between the prices are likely to be small, this can be done profitably only with computers examining a large number of prices and automatically exercising a trade when the prices are far enough out of balance. The activity of other arbitrages can make this risky. Those with the fastest computers and the most expertise take advantage of series of small differences that would not be profitable if taken individually. Economists use the term global labor arbitrage to refer to the tendency of manufacturing jobs to flow towards whichever country has the lowest wages per unit output at present and has reached the minimum requisite level of political and economic development to support industrialization. At present, present, many such jobs appear to be flowing towards China, though some that require command of English are going to India and the Philippines. In popular terms, this is referred to as offshoring. Sports arbitrage. Numerous internet bookmakers offer odds on the outcome of the same event. Any given bookmaker will weight their odds so that no one customer can cover all outcomes at a profit against their books. However, in order to remain competitive, they must keep margins usually quite low. Different bookmakers may offer different odds on the same outcome of a given event. By taking the best odds offered by each bookmaker, a customer can under some circumstances cover all possible outcomes of the event and lock a small risk-free profit, known as a Dutch book. This profit will typically be between 1% and 5%, but can be much higher. One problem with sports arbitrage is that bookmakers sometimes make mistakes, and this can lead to an invocation of the palpable error rule, which most bookmakers invoke when they have made a mistake by offering or posting incorrect odds. As bookmakers become more proficient, the odds of making an arb usually last for less than an hour and typically only a few minutes. Furthermore, huge bets on one side of the market also alert the bookies to correct the market. Exchange-traded fund arbitrage. Exchange-traded funds allow authorized participants to exchange back and forth between shares in underlying securities held by the fund and shares in the fund itself, rather than allowing the buying and selling of shares in the ETF directly with the fund sponsor. ETF trade in the open market, with prices set by market demand. An ETF may trade at a premium or discount to the value of the underlying assets. When a significant enough premium appears, an arbitrager will buy the underlying securities, convert them to shares in the ETF, and sell them in the open market. When a discount appears, an arbitrager will do the reverse. In this way, the arbitrager makes a low-risk profit, while keeping ETF prices in line with their underlying value. Some types of hedge funds make use of a modified form of arbitrage to profit. Rather than exploiting price differences between identical assets, they will purchase and sell securities, assets and derivatives with similar characteristics, and hedge any significant differences between the two assets. Any difference between the hedged positions represents any remaining risk plus profit. The belief is that there remains some difference which, even after hedging most risk, represents pure profit. For example, a fund may see that there is a substantial difference between US dollar debt and local currency debt of the foreign country, and enter into a series of matching trades to arbitrage the difference, while simultaneously entering into credit default swaps to protect against country risk and other types of specific risk. Price convergence. Arbitrage has the effect of causing prices in different markets to converge. As a result of arbitrage, the currency exchange rates, the price of commodities, and the price of securities in different markets tend to converge. The speed at which they do so is a measure of market efficiency. Arbitrage tends to reduce price discrimination by encouraging people to buy an item where the price is low and resell it where the price is high. Arbitrage moves different currencies toward purchasing power parity. As an example, assume that a car purchased in the United States is cheaper than the same car in Canada. Canadians would buy their cars across the border to exploit the arbitrage condition. At the same time, Americans would buy US cars, transport them across the border, then sell them in Canada. Canadians would have to buy American dollars to buy the cars, and Americans would have to sell the Canadian dollars they received in exchange. Both actions would increase demand for US dollars and supply of Canadian dollars. As a result, there would be an appreciation of the US currency. This would make US cars more expensive and Canadian cars less so until their prices were similar. On a larger scale, international arbitrage opportunities in commodities, goods, securities and currencies tend to change exchange rates until the purchasing power is equal. In reality, most assets exhibit some difference between countries. These transaction costs, taxes, and other costs provide an impediment to this kind of arbitrage. Similarly, arbitrage affects the difference in interest rates paid on government bonds issued by the various countries, given the expected depreciation in the currencies relative to each other. Risks. Arbitrage transactions in modern securities markets involve fairly low day-to-day risks, but can face extremely high risk in rare situations, particularly financial crises, and can lead to bankruptcy. Formally, arbitrage transactions have negative skew. Prices can get a small amount closer, while they can get very far apart. The day-to-day risks are generally small because the transactions involve small differences in price, so an execution failure will generally cause a small loss. The rare case risks are extremely high because these small price differences are converted to large profits via leverage, and in the rare event of a large price move, this may yield a large loss. The main day-to-day risk is that part of the transaction fails. Execution risk. The main rare risks are counterparty risk and liquidity risk, that a counterparty to a large transaction or many transactions fails to pay, or that one is required to post margin and does not have the money to do so. In the academic literature, the idea that seemingly very low-risk arbitrage trades might not be fully exploited because of these risk factors and other considerations is often referred to as limits to arbitrage. Execution risk. Generally, it is impossible to close 2 or 3 transactions at the same instant. Therefore, there is the possibility that when one part of the deal is closed, a quick shift in prices makes it impossible to close the other at a profitable price. However, this is not necessarily the case. Many exchanges and inter-dealer brokers allow multi-leg trades. Competition in the marketplace can also create risks during arbitrage transactions. As an example, if one was trying to profit from a price discrepancy between IBM on the NYSE and IBM on the London Stock Exchange, they may purchase a large number of shares on the NYSE and find that they cannot simultaneously sell on the LSE. This leaves the arbitrager in an unhedged risk position. In the 1980s, risk arbitrage was common. In this form of speculation, one trades a security that is clearly undervalued or overvalued, when it is seen that the wrong valuation is about to be corrected by events. The standard example is the stock of a company, undervalued in the stock market, which is about to be the object of a takeover bid. The price of the takeover will more truly reflect the value of the company, giving a large profit to those who bought at the current price, if the merger goes through as predicted. Traditionally, arbitrage transactions in the securities markets involve high speed, high volume and low risk. At some moment a price difference exists, and the problem is to execute 2 or 3 balancing transactions while the difference persists. When the transaction involves a delay of weeks or months, as above, it may entail considerable risk if borrowed money is used to magnify the reward through leverage. One way of reducing the risk is through the illegal use of inside information, and in fact risk arbitrage with regard to leveraged buyouts was associated with some of the famous financial scandals of the 1980s, such as those involving Michael Milken and Ivan Boesky. Mismatch. Another risk occurs if the items being bought and sold are not identical and the arbitrage is conducted under the assumption that the prices of the items are correlated or predictable. This is more narrowly referred to as a convergence trade. In the extreme case, this is merger arbitrage, described below. In comparison to the classical quick arbitrage transaction, such an operation can produce disastrous losses. Counterparty risk. As arbitrages generally involve future movements of cash, they are subject to counterparty risk. If a counterparty fails to fulfill their side of a transaction, this is a serious problem if one has either a single trade or many related trades with a single counterparty, whose failure thus poses a threat or in the event of a financial crisis when many counterparties fail. This hazard is serious because of the large quantities one must trade in order to make a profit on small price differences. For example, if one purchases many risky bonds, then hedges them with CDSs, profiting from the difference between the bond spread and the CD's premium. In a financial crisis, the bonds may default and the CD's writer-seller may itself fail, due to the stress of the crisis, causing the arbitrageur to face steep losses. Liquidity risk arbitrage trades are necessarily synthetic, leverage trades, as they involve a short position. If the assets used are not identical, or the margin treatment is not identical, and the trader is accordingly required to post margin, the trader may run out of capital and be forced to sell these assets at a loss even though the trades may be expected to ultimately make money. In effect, arbitrage traders synthesize a put option on their ability to finance themselves. Prices may diverge during a financial crisis, often termed a flight to quality. These are precisely the times when it is hardest for leveraged investors to raise capital, and thus they will lack capital precisely when they need it most.